welcoming Adrian Day to our interview seat here at the New Orleans Investment Conference. Adrian, you've been coming to these conferences for so long, and yet you still look so youthful and vibrant up there, and just exciting the audiences with your views as usual. Let's get to the situation that's driving, the fundamental factors driving gold right now. I was talking today about money and debt, and everybody focuses on the U.S. and the Federal Reserve. Looking at the situation in Europe, isn't the problem there, the debt problem, the debt service problem, the quantitative easing, isn't it just as compelling as the case in the U.S.?
Oh, absolutely, and it's not just Europe, in fact, but it's all around the world. I mean, we've seen Japan. Japan has now been in a recession or a deflation, literally, recession or deflation for virtually every year of the last 22 years, and they are expanding their money base tremendously. China, of course, is alternatively easing and trying to hold things in and ease again. Britain is Britain for the size of the economy is expanding even more than Europe and the United States.
Brazil.
Brazil, it's around the world, and that's the key to me. I mean, that's really the key for gold right now. We can talk all we want about the restraints on production, which are true. You know, even though production is up 1% this year, 1%. You know, we're producing less new gold this year than we were in 2001, which, when you think about it, is just unbelievable.
Given
gold's
the new
gone
sources
from
of demand,
250 to 1800. We can talk all we want about India and China, and they're all important because you've got to have both sides of the equation. But the real key to gold is a global monetary system, a monetary situation. You've got expanding money around the world, and you've got low interest around the world. You know, more major countries around the world today have negative real interest rates and positive real interest rates. Well, that's bullish for gold. And I don't see that changing, Brian, anytime soon.
Well, you know, we look at quantitative easing. You know, the Europe announced their version of a qualified unlimited version of quantitative easing. The Spain, Italy, they have to come ask for the help before they can get it. And it still has to go through, they still have to jump through a few hoops to be able to do that. And we look at, after Europe announced their version of it, we had the Fed and Bernanke announcing QE3 and their version of unlimited quantitative easing. Right after that, we saw a parade of countries that then jumped in. So really we're having competitive currency devaluations like we really started talking about a few years back. Really coming to the fore right now again.
Oh, absolutely. Even the strong currencies like, say, Switzerland, you know, they have linked their currency to the euro, as you know, and they have expanded, the Swiss National Bank has expanded their balance sheet about, what, sixfold in the last 2 years? I mean, it's astonishing. And so, no, it's happening all around the world. No country wants their currency to be strong, which of course is a fundamental mistake. You only have a strong, we're getting off topic here maybe, but you can only have a strong economy on a sustained basis with a strong currency. Weak currencies do not beget strong economies. And why people can't learn that lesson, I have no idea.
Well, you get back, and again, getting off topic, you get in the whole issue of central planning and central economic planning and the like. A strong economy begets a strong currency and vice versa.
And vice versa,
And you know, we're looking at quantitative easing is one side of the equation, and the Fed came out just a couple of days ago and extended or reinforced their long-term deadline for a low interest rate environment. They don't really have a choice, do they? Given the debt levels that we're at now.
Okay, yeah, there's always a choice. It depends how much pain you want to take. The real problem, as we were talking beforehand, the real reason for keeping interest rates low in the United States is not because of the housing market, not because of the economy's weak, whatever Ben Bernanke might say, is because of government servicing of the debt. You know, right now, the government servicing of debt is about 11% of government revenue, which is high, but not extraordinarily high. But that's 11% when interest rates are at 70-year lows. If interest rates when they're issuing more debt at the short end of the spectrum, the average of all government debt, all federal government debt maturities right now is about 2.2 years. Historically, over the last 50 years, it's been about six years as the average maturity. In other words, we've got maturities at the short end, where rates are lower, of course, and you've got interest rates at 70-year lows. They can't afford rates to go up, or we suddenly become like Greece.
Exactly. You know, I was pointing in my talk today that the situation we're in now is very much akin to the 1970s, except for the interest rate environment. We have very low interest rates. If we get to a situation where interest rates rise toward the levels of the 1970s, it just becomes an untenable situation very quickly.
No, absolutely. Absolutely. I mean, if we went back to not even the average historical interest rate that the government pays, but even if we only went halfway back towards that, we'd have 20% or more of government revenue being debt service.
I saw an estimate that if interest rates were normalized, probably in the 5 to 6% range, the interest debt service burden in the fiscal budget would be about $650 billion.
Right. That's a more normalized. Yeah,
Yeah.
absolutely. And that's unsustainable.
Right.
The only difference, of course, between America or the United States and Greece, the only big difference, and it's a major difference, is that we can print money, whereas Greece can't. Greece can't print euros.
Right, and they'll be printing a lot of money apparently.
They'll be printing euros, but Greece itself can't print euros. That's
right,
what I'm saying.
right.
Yeah.
But the only way out from under this debt burden, in my view, is monetary inflation. They can't grow their way out of it. They can't raise taxes enough. They can't cut the budgets enough. That debt has to be depreciated by money printing, and that seems like what we're going to get.
Absolutely, it seems like what we're going to get, and it's really, when you think about it, it's a tragedy. It's not just messing up the economy, distorting the economy, distorting investments and so on, but it's really a tragedy for people who've saved money all their lives, people who've done the right thing, haven't got into debt, saved money all their lives, and they see that they're getting 1 or 2% interest rate on their money, and that they were depending on 5 or 6%, and so we are hurting the very sort of foundation, the very cornerstone of the people who've done the right thing all their lives. Because of course, in a period of easy money, it's the debtors who are helped, and it's the savers who are hurt.
And the lower you are in the economic scale, on the income scale, the harder it hits you, and people don't realize that as well.
Of course, yeah. No, of course. I mean, again, they don't realize this. And Mark Farber, who's talking to, at the conference, and, he's very good on this point, that when you have excessive money creation and you have distortion in interest rates, you get bubbles in certain areas, but you always get people at the top being helped. That's the reason why over the last 5 years you've seen the wealth disparity in the United States widen so much. It's because the government is distorting things, and there's people at the top. I'm not speaking as a socialist here, but it's just a fact. It's people at the top who take advantage of those distortions, and
because
people at the bottom can't.
Right.
We should be helping savers, and you help savers by increasing interest rates, not lowering interest rates.
Right.
Interest rates are too low, in my view.
Well, Adrian, looks like it'll be another interesting year ahead of us,
Yeah.
and I'm sure we'll have you back next year. And thank you for your time.
Well, thank you, Brian, very much. Thank you.